For decades, China has been the world's economic success story. Its growth has been staggering. Its exports have revolutionized global trade. But its economy is now showing worrying signs of slowing down. China reported an annualized expected growth rate of 8.1% this year, twice as fast as the Eurozone, but that was almost a full percentage point slower than the previous quarter. And with China's economy now worth $15,600 billion US, that 1% makes a huge difference. The slowdown is not entirely unexpected. For years, Chinese officials have said that they would be happy with 7 to 8% growth, and would allow the economy to slow down as it became more developed and mature. But this seems to be happening sooner than anticipated. It's partly due to a global slowdown in demand for Chinese exports, which fell 1.8% in February over the same month last year. It's also due to President Xi Jinping's crackdown on corruption, which has discouraged wasteful spending on luxury items such as expensive liquors and cigarettes. The big question is whether China can transition from a state-dominated investment economy to one driven by consumer spending. Enjoying the video so far? Please remember to like, share, and subscribe for more informative content. Also, let us know in the comments section any other topics you would like us to cover. Thanks! To understand why China's economy is slowing, imagine a company town. The firm in question is the state, and the town is the whole country. The largest employer in any company town is the company that owns it, and so it is in China. The state employs a fifth of all urban workers, according to Nicholas Lardy at the Peterson Institute for International Economics, a think tank. It controls banks and most big businesses, including nearly all natural resource firms. The private sector supplies jobs for most of the other 4/5 of urban workers, but even here, the state plays a huge role as customer, supplier, regulator, and competitor. In other words, China's economy is run like a giant version of those 1970s Japanese trading houses that dominated their country's business landscape, except that they employed only a tenth of workers. That makes China vulnerable to what happened at that time to Japan's trading houses. They overinvested and went bust. Furthermore, China's economic growth has been phenomenal over the past 3 decades, and especially since the financial crisis. The country has become one of the world's largest manufacturing and trading nations, and its influence on global markets for commodities from iron ore to coal to foodstuffs is huge. But China faces serious challenges to its continued growth, such as an aging population, high levels of debt, and an over-reliance on exports and investments. The country's GDP growth slowed to 6.7% in 2016, its lowest pace in 26 years. And although it remains robust by Western standards, Chinese authorities are keen to rebalance the economy towards more sustainable sources of growth. But with investment accounting for 45% of GDP, consumption a relatively weak 35%, and net exports contributing a further 20%, the economy remains heavily dependent on investment and trade. Not only that, the outbursts of pandemic and the continued trade war between Beijing and Washington have also triggered multiple politico-economic war fronts for the Asian giant. China's authorities are fond of saying that their country has many weapons at its disposal to keep its economy growing. If a sharp slowdown were to threaten, the government could lower interest rates and bank reserve requirements, cut taxes, boost infrastructure spending, or even allow firms to delay paying the value-added tax. That is reassuring for the short term, but it does not address a deeper problem. China's economy is increasingly vulnerable because it relies so heavily on private sector debt, and in particular on borrowing by real estate developers. China's total debt rose from 144% of GDP in 2008 to 282% in mid-2018. The biggest reason has been property. From 2006 to 2017, developers racked up $3.3 trillion in outstanding loans, almost doubling their debt as a share of GDP to 31%. That increase was bigger than the rise in total outstanding corporate debt in America over the same period, and the equivalent of more than half of China's annual economic output last year. In addition, the result of these developments is not immediate. Rather, they are just surfacing right now. The question is, how much more borrowing can China sustain? The country's total debt has risen by roughly 2/3 since 2012 alone, and despite Beijing's efforts. The most obvious way a country can fail economically is by losing its competitive advantage. If your country can't compete, it will produce less than other countries, and so will be poorer. The trouble with this analysis of China is that it overlooks why China's competitive advantage exists. The reason China is cheap to manufacture is that so many of its people are poor. That's a disadvantage for the Chinese, but an advantage for anyone who wants to produce goods cheaply. They need only find some way of exchanging what they make in their own country for what China makes more cheaply. Now, as it happens, there's one thing you can make in every country, and that's money. So any place that's sufficiently poor can also be cheap to manufacture in, as long as you pay them in money rather than goods. You might think that this would require a complicated international financial system like the one we have today, but not really. All that would be required is a single commodity money universally accepted everywhere, and gold was such a money until recently. It still serves in that capacity where official currencies fail, as they do regularly in countries like Zimbabwe or Venezuela. It is a problem that only the Chinese themselves can solve. The Chinese government is in an awkward position. If it wants to avoid financial crisis, it must allow more of the consequences of economic mismanagement to be felt at home rather than abroad, and it must give up its long-held desire for control over the economy. But if it does this, it may bring on the very crisis it fears by undermining the legitimacy of the Communist Party. The risk for China is not that its financial system will collapse tomorrow, but that it will continue to muddle through indefinitely, thereby wasting resources and creating resentment among creditors and investors overseas. Arguably, China's financial system has been in trouble ever since the country began its transition from central planning to a market economy back in 1978. It is still a state-dominated system, where banks are almost wholly state-owned, credit is controlled by the government, and listed companies are tightly held by large state enterprises or connected individuals who have accumulated large shareholdings through preferential access to bank loans. The most important economic story this year has been the slowdown in China, and the most important question about that slowdown is whether it's temporary, a function of a credit-fueled stimulus program whose effects are now fading, or whether it's structural and reflects deeper problems with the Chinese economy. The answer to the question matters a great deal to the world. China is still growing fast enough to contribute significantly to global growth, and if Goldman Sachs is right, it will be contributing more than either the United States or Europe by 2015. But if China's growth slows for structural reasons, it will have implications for commodity prices and global trade. It would also have important political implications. Part of the deal that the Communist Party leaders have made with their people is that they can deliver steadily rising living standards, and that's harder to do when your economy is only growing at 7% per year than when it's growing at 10%. China has a lot of debt, but it is not clear who is exposed. In theory, much of the debt was issued by local governments and held by banks. In practice, the lines are blurred, and there's a lot of worry about how strong the banks are. But China does have a lot of very rich people. Some of these rich people are on paper billionaires who own large stakes in Chinese companies. But because many Chinese companies are run by the state, this paper wealth doesn't necessarily translate into economic power. Other rich Chinese people do have economic power. At least some of the super rich have been able to take their money out of China and diversify their holdings in other countries' currencies and stocks. The biggest source of weakness in any economy is not its currency or bond market, but its politics. If all else fails and the economy tanks, China's leaders may be able to distract angry citizens with patriotic fervor at foreigners, especially America, which would be convenient given upcoming elections there. The outlook for Chinese small businesses has worsened since then. China's new leadership team is currently meeting at the annual National People's Congress to finalize its economic policy agenda for this year. But even if it wanted to redress some of the existing problems, it would not be easy. In theory, small businesses should be able to find financing from private investors or banks, but smaller companies are less likely to receive bank loans than their larger counterparts because they are seen as riskier investments. At the same time, private investors are deterred by laws and regulations that make it easier for officials to intervene in their affairs. The economy is generally assumed to be a complex system. It is to some extent, but not as much as you think. There are only three things in the economy: companies, people, and the governments. Companies make stuff, people do stuff, governments regulate stuff. If things are that simple, one question comes to mind. Why is the Chinese economy still running smoothly? Why is it always so talked about? Is the Chinese economy in danger, or is it just ideological warfare only? Well, only time can answer these questions.